Welcome to our deep dive into cash flow management. Whether you're running a business or managing personal finances, understanding cash flow is essential. Cash flow refers to the movement of money in and out of your accounts, and it's the lifeblood of any financial operation. In this video, we'll explore why cash flow matters, how to track it, and practical strategies to optimize it. Let's start by defining cash flow and its importance in everyday financial decision. By the end, you'll have actionable insights to improve your financial health and stability. Cash flow is more than just a number on a spreadsheet. It's the pulse of your financial life. Positive cash flow means you have more money coming in than going out, allowing you to invest, save, and grow. Negative cash flow, on the other hand, can lead to stress, debt, and missed opportunities. Businesses rely on healthy cash flow to pay employees, purchase inventory, and expand operations. Individuals use cash flow to cover expenses and plan for the future. Understanding its significance sets the stage for effective management. There are three main types of cash flow: operating, investing, and financing. Operating cash flow is generated from day-to-day business activities like sales and expenses. Investing cash flow comes from buying or selling assets such as equipment or property. Financing cash flow involves borrowing money or repaying loans. Each type plays a unique role in your overall financial picture. Knowing the differences helps you analyze where your money is coming from and where it's going, making it easier to spot trends and make informed decisions. Tracking cash flow is the foundation of effective management. Start by recording all income and expenses, whether you're using spreadsheets, accounting software, or apps. Regularly reviewing your cash flow statements helps you identify patterns, spot potential issues, and plan ahead. For businesses, this means monitoring sales, payments, and expenditures. For individuals, it's about keeping tabs on salary, bills, and discretionary spending. Consistent tracking empowers you to make proactive adjustments and avoid surprises. Cash flow statement is a powerful tool for understanding your financial health. It summarizes all cash inflows and outflows over a specific period, giving you a clear picture of your liquidity. Businesses use cash flow statements to assess performance and plan for growth. Individuals can use them to manage budgets and savings. By analyzing these statements, you can pinpoint areas for improvement and ensure you're on track to meet your goal. Managing cash flow isn't always straightforward. Common challenges include late payments, unexpected expenses, and fluctuating income. Businesses may struggle with seasonal sales or delayed invoices. Individuals might face irregular paychecks or sudden bills. Recognizing these challenges early allows you to develop strategies to overcome them. In the next scenes, we'll discuss practical solutions to keep your cash flow steady and predictable. Budgeting is a proactive way to manage cash flow. By setting spending limits and prioritizing expenses, you can ensure you have enough money for essentials and avoid overspending. Start by listing all sources of income and fixed costs, then allocate funds for variable expenses. Regularly update your budget to reflect changes in income or spending habits. This approach helps you stay in control and make informed financial decisions. Forecasting cash flow involves predicting future income and expenses. This is especially important for businesses planning growth or individuals preparing for big purchases. Use historical data to estimate upcoming cash inflows and outflows. Factor in seasonal trends, market changes, and potential risks. Accurate forecasting helps you anticipate shortfalls, plan for investments, and avoid financial surprises. Improving cash flow requires a combination of increasing income and controlling expenses. For businesses, this might mean boosting sales, negotiating better payment terms, or reducing overhead. Individuals can look for ways to earn extra income, cut unnecessary costs, and shop smarter. Small changes add up over time, leading to a healthier financial outlook. We'll explore specific tactics in the next scene. One way to improve cash flow is by increasing your income. Businesses can expand product lines, enter new markets, or offer promotions. Individuals might take on freelance work, sell unused items, or pursue side hustles. The key is to diversify income streams and maximize earning potential. With more money coming in, you'll have greater flexibility and security. Controlling expenses is equally important for cash flow management. Review your spending regularly and identify areas where you can cut costs. Businesses might renegotiate contracts, switch suppliers, or streamline operations. Individuals can reduce discretionary spending, shop for deals, and avoid impulse purchases. By keeping expenses in check, you free up cash for savings and investment. For businesses, managing receivables is crucial. Ensure invoices are sent promptly and follow up on late payments. Consider offering incentives for early payment or implementing stricter credit policies. Efficient receivables management keeps cash flowing and reduces the risk of bad debt. Individuals can apply similar principles by tracking money owed and setting reminders for repayments. Managing payables involves controlling when and how you pay bills. Businesses should negotiate payment terms with suppliers and avoid paying too early unless discounts are offered. Individuals can schedule bill payments to align with income cycles. This approach helps maintain liquidity and ensures you always have enough cash on hand to cover obligations. Startups face unique cash flow challenges. Initial expenses are high and income may be unpredictable. It's vital to create detailed cash flow projections and monitor spending closely. Seek funding options such as loans or investors to bridge gaps. Focus on building a customer base and generating consistent revenue. With careful planning, startups can survive and thrive. Small businesses often operate with tight margins. Managing cash flow is critical to staying afloat. Regularly review cash flow statements, adjust budgets, and plan for slow periods. Build relationships with suppliers and customers to negotiate favorable terms. Invest in tools and technology that streamline operations and improve efficiency. Cash flow management isn't just for businesses. Individuals benefit from tracking income and expenses, setting budgets, and planning for the future. Use apps or spreadsheets to monitor your cash flow and identify areas for improvement. Set aside funds for emergencies and long-term goals. With disciplined management, you can achieve financial stability and peace of mind. Credit plays a role in cash flow management. Businesses and individuals may use credit to bridge short-term gaps. However, relying too heavily on credit can lead to debt and financial strain. Use credit responsibly, pay off balances promptly, and avoid high-interest loans. Proper credit management supports healthy cash flow and financial resilience. Investing can impact cash flow positively or negatively. Businesses may invest in equipment or expansion, while individuals invest in stocks or real estate. Consider the timing and liquidity of investments to avoid cash shortages. Diversify investments to balance risk and return. Smart investment decisions enhance cash flow and support long-term growth. Savings are a buffer for cash flow fluctuations. Set aside a portion of income each month for emergencies and future needs. Businesses should maintain reserves to cover slow periods or unexpected expenses. Individuals benefit from building an emergency fund and saving for goals like travel or retirement. Consistent saving habits strengthen cash flow and provide security. Taxes can affect cash flow significantly. Plan ahead for tax payments by setting aside funds throughout the year. Businesses should track deductible expenses and file returns promptly. Individuals can use tax planning strategies to minimize liabilities. Staying organized and proactive prevents cash flow disruptions and avoids penalties. Debt management is crucial for cash flow. Businesses and individuals should prioritize paying down high-interest debt and avoid taking on unnecessary loans. Consolidate debts where possible to simplify payments and reduce costs. Monitor debt levels and ensure repayments fit within your cash flow plan. Responsible debt management supports financial health. Growth opportunities often require upfront investment. Businesses may need to purchase equipment or hire staff, while individuals invest in education or property. Plan for these expenses by forecasting cash flow and setting aside funds. Growth should be sustainable and aligned with your financial goals. Careful planning ensures you don't overextend and jeopardize cash flow. Technology can streamline cash flow management. Use accounting software, budgeting apps, and automation tools to track income and expenses efficiently. Businesses benefit from integrated systems that handle invoicing, payments, and reporting. Individuals can use mobile apps to monitor spending and set reminders. Embracing technology saves time and reduces errors. Planning is the cornerstone of cash flow management. Set clear financial goals, create budgets, and forecast future needs. Businesses should develop strategic plans that align with cash flow projections. Individuals can plan for major expenses like vacations or home purchases. Regular planning keeps you focused and prepared for changes. Risk management protects cash flow from unexpected events. Businesses should ensure assets, diversify revenue streams, and prepare for market changes. Individuals can use insurance, build emergency funds, and avoid risky investments. Identifying and mitigating risks ensures cash flow remains stable even during challenging times. Effective communication supports cash flow management. Businesses should keep open lines with suppliers, customers, and employees. Individuals can discuss financial goals and plans with family members. Clear communication helps resolve issues quickly and builds trust, which is vital for maintaining steady cash flow. Teamwork is essential for managing cash flow in organizations. Collaborate with finance teams, managers, and staff to monitor and improve cash flow. Share insights, set common goals, and work together to solve challenges. Individuals can seek advice from financial advisors or partners. Teamwork leads to better decisions and stronger financial outcomes. Analytics provide valuable insights into cash flow trends. Use data analysis tools to track performance, identify patterns, and forecast future needs. Businesses can leverage analytics to optimize operations and make strategic decisions. Individuals can analyze spending habits and adjust budgets accordingly. Data-driven decisions improve cash flow management and support growth. Regular review is key to maintaining healthy cash flow. Schedule monthly or quarterly check-ins to assess your financial position. Businesses should review cash flow statements, budgets, and forecasts. Individuals can evaluate spending, savings, and progress toward goals. Reviewing helps you spot issues early and make necessary adjustments. Cash flow management is a continuous process that requires attention, planning, and adaptability. By understanding the basics, tracking income and expenses, and implementing practical strategies, you can achieve financial stability and growth. Whether you're managing a business or personal finances, the principles remain the same. Take the next step by applying these tips, reviewing your cash flow regularly, and staying proactive. With dedication, you'll unlock new opportunities and secure your financial future.